Welcome to Stocks Visionary channel. Before we start, don't forget to click the subscribe button. Today's video is about options trading for beginners. Don't worry, I'm going to keep this very simple. It's going to be so easy for you to follow along. And I want you to know that I personally use options in the stock market to maximize my gains. So I'm a believer and I'm going to teach you how it's done. In today's video, we're focusing on call options. I'll make additional videos about options trading for beginners, and those videos will cover covered calls, puts, and also cash secured puts. But today's video is about call options, okay? So let's break this down to the fundamentals. So what are options? Options are simply contracts. So it's essentially a deal between you and another person. So I want to show you this from the perspective of the buyer. So in our example, you will be the buyer of the options contract, and again, this is a call option. Now we'll just pick any stock, and in this example we'll use Yelp stock. So the price of Yelp is at $35.84, but to keep it simple, let's just round it up and say that Yelp is at $36 a share. So what if I tell you I'll give you the option to buy Yelp at $38 a share in the next 30 days? And for you to have that option, you pay me. So, is that a good deal or is that a bad deal? Well, honestly it's hard to say because we don't know if the stock price of Yelp will go up or down in the next 30 days. But let's just say that you buy that contract for $80 and now you have the option to buy Yelp at $38 within the next 30 days. So here's how you win. The price of Yelp right now is at $36, so let's say that within the next 30 days, the price of Yelp hits $42. Then in this situation you're going to make good money because here's what's going on. So the options contract that you bought was a call option. So you paid for the option to buy a stock at a certain price within a certain amount of time. Now in our example, Yelp hits $42, so you have the option to buy Yelp at $38. So would you buy Yelp for $38 in this situation? So the answer, well, it should be of course you would. Because you could buy it for $38 and then immediately sell it for the going rates of $42, and then you end up with a gain of $4 a share. So here's what your profit would look like. You buy Yelp at $38. You sell it for $42, but you have to remember that you paid 80 cents to have this option. So you net a profit of $320, and I want you to know that this is a real-life example. You could take a look for yourself. So this is the Robinhood platform, and all platforms will look pretty similar to this. So you see at the bottom right where it says Trade Yelp Options, which I outlined in red. So you click on that and it takes you to this. So I just want to say, don't be intimidated. I'm going to walk you through this, and it's going to be very easy to understand. These are the options contracts at different price points. If you want the contract to be at $38, then $38 will be your strike price. So as you can see here, you're going to see the options contracts with different strike prices: $35, $36, $37, $38, $39. That's just the limit of my screenshot, so you can go for an options contract with a strike price at $50 or even at $20. But I'm going to explain the difference to you in just a little bit. But for right now, let's just focus on you buying the call option at a $38 strike price. Take a look for yourself. That options contract is selling for $80. So is our example of Yelp going to $42 in the next 30 days possible? Well, take a look for yourself. So I've highlighted in red in the top left. Yelp has gone up by almost $7 in the past 30 days. Now let's go back to the topic of you winning and making money. So Yelp is at $36 currently. You bought the call option with a strike price at $38, and that option will cost you $80. So if Yelp goes above $38.80 in the next 30 days, then you're going to be at a profit. So maybe, who knows, Yelp could go up to $40, it can go up to $42, maybe $50, it could go to $100. I mean, that would be unrealistic, but it's not impossible. If Yelp skyrockets, then you're going to make so much money because you're going to have the option to buy it at $38. So if you buy the call option, then you want Yelp to go up as much as possible, as fast as possible, because if you think about it, it's very straightforward. If Yelp goes to $100, you can buy it for $38 and then sell it immediately for $100. So I just want to point out that that's the happy scenario where everything works out and you make a lot of money, but we have to talk about the flip side of the coin. we have to talk about how you can lose money and how you can get absolutely destroyed. So the danger is that you have a limited amount of time before your contract expires, and in that time if the price of the stock doesn't do what you want it to do, in that set amount of time, then you're going to end up with a worthless contract. So I have to show to you. Here's how the unhappy scenario plays out. Yelp is at $36 right now. You bought the call option to have the option to buy Yelp at $38 in the next 30 days. If Yelp is at $38 or below, then your contract is worthless. So I want to demonstrate the good and bad scenarios for you. There are 4 scenarios. So here's scenario number 1. Yelp is at $36 a share. Currently you have the option to buy it at $38 within the next 30 days, and let's just say that the stock price goes down to $30. In this scenario your contract is terrible, it's worthless. Why would you use your contract to buy Yelp at $38, when you could just buy it on the open market for $30, and remember you paid 80 cents for that contract? So you wasted your money and you lose. So here's scenario number 2. Yelp is at $36. You have the option to buy it at $38 within the next 30 days, and let's just say that the stock price goes up to $37. In this situation it's the same thing. Why would you use your contract to buy Yelp at $38, when you can buy it on the open market for $37? So yes, the price of Yelp stock did go up. It went up from $36 to $37, however it didn't go up enough because it's still below the strike price on the contract. So you wasted 80 cents to buy that contract, the stock went up but not enough and you still lose. Moving on to scenario number 3. So Yelp is at $36. You have the option to buy it at $38 within the next 30 days, and let's just say that Yelp goes up to $38.50. So in this scenario you can buy Yelp for $38, and you could sell it for $38.50. So that is a gain of 0.50, so congratulations. However, you still lose money because you paid 80 cents for the contract. So your true cost basis it's $38.80 and you can sell it for $38.50. So you still lose, but at least it's not a total loss. So here's scenario number 4. So Yelp is at $36. You have the option to buy it at $38. Within the next 30 days Yelp goes above your cost basis of $38.80 and then you're going to be at a profit. And the more it goes up, the more money that you'll make. So basically in this situation you want the price to skyrocket. For example, the best news would be, Google decides to acquire Yelp for $60 a share. And Yelp stock skyrockets in price within your 30 days. Now here's the thing. I want to tell you this because this is so important. With call options or options contracts in general you can buy and sell them just like a stock. So in our example, if Yelp goes to $60 a share, you don't literally have to buy Yelp for $38 and then sell it for $60. You can just sell the options contract itself. But if Yelp is at $60, and you want to buy Yelp for $38 and just hold on to it, you can exercise the option and buy it for $38 and just hold on to the stock, and then your options contract it'll disappear from your account. And then you'll end up with the Yelp stock. Now let's go back to the options screen. So I want to explain this whole option chain to you. That's what the call is. You can buy call options at different strike prices. So let me tell you what is going on here. Okay. I want to ask you a question. It's pop quiz time. So I'm going to give you 2 offers. You tell me which one sounds better to you. Yelp is currently at $36. So here's my first offer. In the next 30 days I'll give you the option to buy Yelp at $38, and my second offer, in the next 30 days I'll give you the option to buy Yelp at $39. So which one sounds better to you? Of course option number 1 sounds more appealing, because I would rather have the option to buy Yelp at $38 instead of $39. Therefore the contract at a $38 strike price is more appealing. Okay, but here's the thing. These circumstances they're factored into the price of the options contract. Now I want you to compare the contract at $38 versus $39. The contract at $38 is selling for 80 cents. The contract at $39 is selling for 55. So if you want to buy a contract with a higher strike price, the contract will be cheaper. That's because it's less probable that Yelp will hit 39, compared to 38. So in this case they need to offer you a cheaper price. So take a look at the $37 strike price that's trading for $115. That contract it's more expensive because it's not that far-fetched that Yelp will go from 36 to 37 within the next 30 days. Now I want to teach you about the duration of the options contract. So if you're thinking that this whole thing, everything that we're talking about, if you think that it sounds risky, because, well, you don't know what's going to happen in the next 30 days with the Yelp stock. If that's how you think, then I would say you're absolutely correct. I would agree with you, because 30 days is not a lot of time. But what if I told you, the Yelp is at $36? I'll give you the option to buy it at 38, but I'll give you that option for 5 months. So that scenario it would be more appealing to you because you have more time for Yelp to go up. However, those favorable conditions, they're taken into consideration. Therefore, if you want more time on your contract, then you're going to pay for it. So take a look for yourself. I circled at the top your ability to choose the expiration dates of the contract. So we're using the same strike price at 38 for a contract that expires in 7 months. This contract is going to cost you $3.90. So, compare that to the contract that expires in 30 days that's going for $0.80. If the expiration date of the contract is sooner, then the contract will be cheaper. If the expiration date is further out, then the contract will be more expensive. Now I must clarify this one last thing because it's very important. Options contracts are for 100 shares. So if you buy one options contract of Yelp at a $38 strike price, then you're buying the option to buy 100 shares of Yelp at $38, and the contract price it's quoted at 80 cents. Right, so that's 80 cents a share, but you have to remember that you're dealing with 100 share increments. So if the options contract says 80 cents, then the options contract will cost you $80. So if you buy 5 options contracts, is going to cost you $400.